Welcome back to the Concierge Corner. My name is Don Tiegs with IFC National Marketing. So, this is a place where we help you turn client conversations into clarity, confidence, and ultimately results. Now, if you remember, last week we talked about one of the biggest fears retirees face, and that is running out of money. We explored how that fear often comes with uncertainty, like, will my income last? What happens if the market drops? Or what happens if my savings just don't grow fast enough? So that brings us right into this week's topic because even retirees who are doing the right things often share one common frustration, and that is low returns. They're watching CD rates barely keep up with inflation, and they're seeing their savings sit idle, while the market feels just a little too risky to trust. And many are realizing that playing it safe might actually be costing them more than they think. So, we as insurance agents, this is where we can step in to help clients find stability without stagnation. So, let's start with something simple, something familiar, like the bank CD. It's very straightforward. You lock in a rate, you get predictable interest, and at maturity, you get your principal back. But most top CD rates today are barely keeping up with inflation. So that means your client's money might feel safe, but it's quietly losing value. Now let's compare that to a fixed rate annuity, also called a MIGA or a multi-year guaranteed annuity. These work a lot like CDs. You lock in your money for a set period, you earn a guaranteed interest rate, but here's the kicker. The rates on MIGAs are usually higher than those of CDs of the same term. And unlike CDs, your client's interest grows tax deferred, meaning they're not paying taxes on those gains every year unless they make a withdrawal. That allows their money to compound even faster. Now, some MIGAs even allow for up to a 10% penalty-free withdrawal each year, giving your clients flexibility if they need some liquidity. Now, you might be asking, so how can insurance companies pay more than the banks? Well, banks make most of their money on low-interest loans and short-term deposits. Insurance companies, on the other hand, they're going to take a longer investment approach using more diversified portfolios like bonds and real estates and other institutional investments. That structure gives them more flexibility to pass along better yields to policyholders. For many retirees, that difference in strategy can mean a meaningful bump in safe, predictable returns without venturing into the market. Now, let's talk about that. Let's talk about another source of frustration, and that is the market side of things. Even clients who are invested often overlook something called the sequence of returns risk. This is the risk of when market losses happen, not just how big they are. So imagine two retirees, both with, let's say, $100,000 that are invested in the market. One starts taking withdrawals in a year of very strong market returns, and the other, just 2 years later, take money out right before a downturn. Even though their average returns might look similar over time, their outcomes can be dramatically different. One portfolio may still have money 20 years later, while the other could be depleted halfway through retirement. So that's the sequence of returns risk. And that's where fixed index annuities, or FIAs, come in. A fixed index annuity, offers the balance that many retirees are looking for. They're looking for protection from market downturns, but they're also looking for growth, and this growth potential linked to an index. Now, clients can earn interest based in part on the performance of an index like the S&P 500, but without the risk of losing principal if that market drops. And these annuities also have a feature called the annual reset. So the annual reset, this locks in gains each year so that even if the market falls, those gains can never be lost. And when the next year starts, the new growth begins from a lower index value, meaning they're positioned to capture future recoveries more effectively. So in short, FIAs can smooth out the volatility that keeps retirees awake at night. They actually protect the downside while allowing participation in the upside. So here are a few conversation starters that you can use with your clients this week. Like, how do you feel about your returns that you're getting on your savings right now? Or if you could earn a higher guaranteed rate without risking your principal, would you give that more consideration? Or what would it mean to you if you knew that your money could grow but could never go backwards? Or have you thought about the timing of market losses and how that could affect your income in retirement? You see, these questions open a door to understanding the client's frustrations. And it really positions you as their problem solver. So at the end of the day, retirees aren't chasing the higher returns. What they're chasing is confidence. Confidence that their money is going to last. Confidence that they're earning a fair return for the risk that they're taking. And confidence that they have someone in their corner, like you, helping them make sense of it all. And that's what we do here through the IFC Concierge program. So whether it's comparing MIGA rates, illustrating FIAs, or finding the right product mix, I'm here to help you every step of the way. So if you've got a client that's frustrated with low returns, let's talk. Because together we can turn that frustration into a strategy and everybody wins. So if you like what you've heard and you want to learn more, feel free to reach me at 763-265-3297. All right, so next week on the Concierge Corner, we'll dive a little deeper into market volatility and how your clients can safeguard themselves against another market crash. Until then, if you want to learn more, feel free to reach me at 763-265-3297. Thanks so much for watching, and I'll see you next week on the Concierge Corner. Have a great day.